This is Macro Horizons, episode 344, Shutdown and Out, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of October 6th. As we look forward to the shutdown-inspired empty data calendar ahead, we cannot help but notice that the auctions are still on schedule. As they say, the bonds must go on. Thanks, Besson. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the most impactful development was the fact that the U.S. federal government has entered a shutdown. This is the 11th such episode, and it's notable that the last shutdown in 2018 and 2019 was under the Trump administration as well, and lasted 35 days. Typically, shutdowns had previously been shorter in duration, sometimes lasting as little as 1 day, sometimes 3, 4, 5 days. The fact that the most recent shutdown went over 30 days has led the market to debate precisely how long we should expect the current shutdown to last. To this end, we conducted a client survey that found, on average, investors were expecting the government shutdown to last 17 days. That will put us well into the middle of October and presumably prevent both the market and the Fed from having the core CPI data as well as payrolls. The BLS has made it very clear that they will not be updating their website, which means that they will not be publishing the marquee data points of payrolls, unemployment rate, and the inflation series. We also won't get the aggregate jobless claims numbers or a number of the other official data points on which investors have previously relied. Instead, the market will have the opportunity to trade off of the private data, ADP, ISM, University of Michigan. All of these data points will continue to be published and presumably carry more weight for investors' outlooks. This is not to suggest that the BLS data has lost its relevance indefinitely, but for the next couple monthly cycles of data, one should expect the market will de-emphasize what will clearly be distorted data points as a function of the shutdown. This particular shutdown also has the added nuance of the administration suggesting that it won't rehire all of the furloughed workers. In the past, when the government shut down, while affected federal employees didn't receive a paycheck, when the shutdown ended, they were rehired into their prior positions and given back pay. If the administration follows through on suggestions that it will use this shutdown as an event to reduce the size of the overall federal payroll, it wouldn't be difficult to envision that not all furloughed employees will be returning. This will have real implications for the unemployment rate, for the real economy, and presumably for the broader tone of the labor market going forward.
Well, it was a bit of an odd week in the Treasury market. Obviously, the typical data slate was distorted by the government shutdown with no jobless claims data and with NFP delayed. The market was left to interpret the other data series of note, which included ADP that showed a negative read around private hiring for September, and that, along with ISM manufacturing and ISM services, was the bulk of what the market had to go off of in terms of the labor market update for last month. What this translated to in terms of the price action was a bullish consolidation as we saw 10-year yields pull further back from what we're characterizing as the top of the yield range at 420, and now, frankly, given what has been an undoubtedly wait-and-see cycle, the market is once again in wait-and-see mode. We'll see how long the government shutdown lasts, and when it is, we'll ultimately get these top-tier data releases. As it relates to the Fed, there's been no shortage of rhetoric from both the hawks and the doves, but without any data, we're of the opinion, and we'll argue the market is as well, that the Fed's previously communicated bias, aka a 25 basis point cut in October and December, will remain intact. So in this case, no news is cutting news, as the case may be.
And I think that that's a fair assumption going forward. The Fed started the process of normalization in September, and barring a sharp increase in inflation, which frankly we're not going to see even if it does occur via the data, then it follows intuitively that the Fed should continue the process back to neutral. The question is, where is neutral? Is it 350? Is it 3%? For the time being, at least, we're content to take the Fed's SEP at face value and assume that we're getting back to 3% at some point. The market is pricing that in for 2026. The Fed's messaging is 2027 or potentially later. We're comfortable following the market on that for obvious reasons. Now, there's a very big question about the duration of the shutdown. We only have the context of the 10 other government shutdowns in the U.S. that have occurred over recent history. And with the 2018-2019 shutdown at 35 days, we're using that as perhaps the upper bound of how long it could last. But if we've learned anything from Trump 2.0, it's that the traditional rules do not necessarily apply. Translating that into a strong conviction biased on the Treasury market is challenging for obvious reasons, but we do ultimately believe that the extended period of uncertainty will create a bullish underpinning for the Treasury market, particularly further out the curve, as duration becomes more and more attractive the further we get into the cycle. As a market, we're comfortable with the narrative that the Fed won't have any real new information when it meets at the end of October. However, that's not entirely true. The Fed, as well as the market, will have the information contained in the fact of whether or not the government shutdown persists. Said differently, if it only lasts a week or two, then the government will be reopened by the time that the Fed meets, and presumably the longer-term economic implications from the shutdown will be less. On the flip side, if the government is still closed when the Fed meets in late October, that information will contribute further to any dovishness and presumably leave the committee comfortable with penciling in a few more cuts for 2026.
And we expect this is going to be the next leg of the macro narrative to play out once we get through the government shutdown, once we have clarity around Trump's threats to fire government workers in response to the shutdown, and really just how severe this current inflection in the labor market is ultimately going to be. Even with potentially no data this month, it's hardly up for debate at this point that the labor market is cooling, and despite what some of the more hawkish rhetoric might suggest, we'll argue it's also become clear that the Fed is not necessarily entirely ignoring inflation, but has certainly prioritized the employment side of the dual mandate in terms of their near-term expectations for monetary policy. So, drawing this logic forward beyond the end of this year and maybe 2 cuts, maybe not, and into 2026, what this implies is that from a departure point of 70 or 75 basis points priced in terms of rate cuts over the entirety of 2026, is that if the Fed is content to downplay the upside risks to inflation as a function of tariffs or as a function of easier monetary policy, then in the event that the unemployment rate really starts to accelerate higher and the accompanying recessionary concerns become much more severe, then there's a lot more capacity for cuts to be priced in, and for not only a return to neutral, but even the potential for a drop back into accommodative territory from a policy rate perspective. In terms of our longer-term expectations for outright rates in the shape of the curve, especially from current levels, this keeps our willingness to re-engage with steepeners and take advantage of backup and outright yields intact as we wait for the next piece of real economic information ahead of the October FOMC.
And it's also important to keep in mind that the 2-year sector has remained remarkably stable around 350. Now, as you pointed out, Ben, the market isn't pricing in cutting rates below neutral, and it won't be until investors really start to be worried about a recession that we would expect the 2-year sector to rally significantly through 350. Further out the curve, 10-year yields drifting below 4% would be very consistent with both our outlook as well as the notion that the longer uncertainty persists, the more attractive duration becomes. It is worth making the observation that in the context of the major bond bearish risks in 2025, we moved beyond a lot of those key unknowns. First up was whether or not the trade war would trigger a wholesale buyer strike in U.S. Treasuries. That has clearly not been the case. We've seen solid auction performance. There's been plenty of participation in the secondary market, and concerns about overseas buyers stepping back from the Treasury market have clearly abated. There was also the concern that Treasuries would lose their status as a safe haven asset. That has not come to fruition, which is a point that was only reinforced by the shifting sentiment around the labor market following the significant benchmark revisions, as well as this summer's lackluster payrolls prints. Let us not forget that the trade war was also seen as potentially triggering a magnitude of reinflation that would get the market concerned about an episode comparable to 2022 or 2023. That clearly hasn't happened, and while there has been tariff pass-through evident via core goods prices, the full impact wasn't condensed into the first 4 months. And that's the key takeaway. If tariff pass-through is going to slowly trickle into the real economy over 6, 9, 12 months, then it has much different implications for both the consumer as well as the market's pricing of forward reflationary risks than if it had all occurred this summer. So, Ben, as you articulated, the Fed now has the flexibility to focus on the employment aspect of its mandate and wait until there's greater information on offer to evaluate how the inflation complex has developed.
And so as we think about the outlook for 2026, with Treasury supply no longer as top tier of a bearish concern, with the labor market now clearly heading in the softer direction, wage growth cooling, consumption still strong, but obviously facing the risk associated with a softer labor market, the list of bearish factors that not so long ago were seen inevitably pushing 10-year yields back well above 5%, has shortened to effectively being only a pickup in inflation. And given what's going to be a consumer base that will probably not be in quite as strong a place as it has been over the past few years, that softer demand backdrop is going to be far more impactful in terms of driving inflation than any supply-side concerns as a function of tariffs, particularly as it relates to the slow trickle-through to the real economy in terms of the upside to prices. Even that underpinning to inflation would easily be overwhelmed by the influence of a higher unemployment rate, and that's not even taking into account how relatively dovish the Fed has become over the past several months. So with safe haven skepticism largely having abated, Treasury supply concerns also being put on the back burner, a softer labor market, and diminishing upside risks to inflation outside of tariffs, we'll argue the nice list as it relates to Treasuries in 2026 is much longer than the naughty one.
Look, I got a rock. In the week ahead, the Treasury market will continue effectively flying blind, given that we expect the government shutdown will continue. To be fair, there is nothing preventing the government from reaching an agreement and turning the lights back on. However, the headlines out of Washington at the moment suggest that we're in for a longer shutdown, perhaps not as long as the 2018-2019 episode, which lasted roughly 35 days, but at least a couple weeks seems to be a reasonable operating assumption. The data on offer in the week ahead was already going to be light, but now that we're missing the BLS official data, the offerings will be limited to Friday's University of Michigan release. We do have the Treasury auctions, which include Tuesday's 3-year auction at $58 billion, and then the 10-year on Wednesday afternoon at $39 billion, as well as the long bond auction at $22 billion on Thursday. In light of the solid sponsorship for Treasury auctions as a general theme over the last few months, we're reasonably optimistic for the upcoming supply. As is always the case, the outright level of yields becomes particularly important at auctions, and we'll be very interested to see how close 10-year yields are to 4% at the time of the reopening. Let us not forget that we also have the FOMC meeting minutes. Recall that this is the first meeting where Stephen Mirren had a vote, and he dissented in favor of a 50 basis point rate cut. Now, since then, the Fed newcomer has had the ability to articulate his argument for a swifter progress back to neutral, and while now the market hasn't embraced his argument per se, we will note that the futures market still suggests Fed funds will be bottoming at 3% next year. Further, within the FOMC minutes, it will be interesting to see any prospects for a greater than 25 basis point cut at any of the next few meetings, although we're erring on the side of assuming that 25 basis points will be the standard size cut unless the Fed believes that there is a greater deceleration risk for the real economy. As it currently stands, the government shutdown has effectively locked in a 25 basis point rate cut in October and presumably one in December as well. If for no other reason, then the Fed simply won't have adequate data from which to deviate from the normalization process that has already been commenced. A similar argument can be made about December, and we're operating under the assumption that by the time we get to the first quarter of 2026, we will be through the distortions created by the government shutdown on the data front, and the cadence of further rate cuts will become data dependent. We've reached a point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the market drifts further into a dataless autumn, we'll offer a nod to those in Washington impacted by the shutdown. The BLS is furloughed, but not forgotten. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.